Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our study on the consolidated statement of profit or loss. And then we are going to straight away take another question. In the previous video, we started by looking at the situation where there is 100% acquisition, and then we consolidated with the only adjustment being intra-group sales of unrealized profit, and then also the pre-acquisition and the post-acquisition profit. Now, in this video, we are going to solve another question, which is going to introduce non-controlling interest, okay? So we are going to solve a question that involves partial acquisition, even though the parent holds majority shares, but there is also minority interest, or what we call the non-controlling interest. And then we are going to solve the question in a more advanced way to enhance our understanding of the previous video before we begin to look at other serious issues that concern the consolidated statement of profit or loss. So without wasting my time, I want to read the question straight away so that we'll be able to solve this question. Okay. JB acquired 60% holding in Ewonia 3 years ago when Ewonia's retained earnings balance stood at 16,000 Ghana cedis. Both businesses have been very successful since the acquisition, and their respective income statements for the year ended 30th June 2019 are as follows. So we have the statement of profit or loss for both JB and Ewonia. Revenue 403,400, 193,000. We have cost of sales 201,400 against 92,600. And then their respective gross profits, as you can see, 202,000 Ghana cedis and 100,400 Ghana cedis. Then there is distribution costs for both, administrative expenses for both. Then there is dividend from Ewonia, which is 15,000 Ghana cedis. So Ewonia is paying dividend to the parent company, JB, at an amount of 15,000 Ghana cedi, which I have already spoken on in the previous video, how we are going to treat this. So we continue from there. Profit before taxes, 176,750 for JB and 68,000 for Ewonia. Then there is income tax expense, which we have taken out from both. So the final profit for the year is 115,000 for JB and 46,000 for Ewonia. Now, there is also a statement of changes in equity extract, which is the retained earnings portion for both JB and Ewonia Limited. And so we have balance at 1st July 2018, that is the opening balance. For JB Limited, it's 163,000. For Ewonia, it's 61,000. And then we have dividends, 40,000 and 25,000 respectively. Profit for the year has been added, and we have a final closing balance of retained earning of 238,000 and 82,000. There is an additional information. During the year, Ewonia sold some goods to JB for 40,000 Ghana cedis, including 25,000 markup. Half of these items were still in inventory at the year end. Required: produce a consolidated income statement of JB Group for the year ended 30th June 2019 and an extract from the statement of changes in equity showing retained earnings. Goodwill is to be ignored. All right. So this is the question. Now you see that this question is an upgrade from the previous question we solved in part 1. In part 1, it was 100% acquisition. Here it is 60% acquisition. And then it's 3 years ago. Then also we are told that there was an intra-group sale. This time it's coming from the subsidiary, Ewonia, who is selling to JB, the parent, okay? And so there will be an issue of non-controlling interest as far as the unrealized profit is concerned. All right. Now we are going to prepare the consolidated statement of profit or loss. And then we're also going to prepare the consolidated retained earnings, which is the consolidated statement of consolidated income surplus, which is similar to the group income surplus or the same as the group income surplus we do when we are preparing for the statement of changes in equity. So we're going to transfer the same idea here. All right. So let us not waste too much time. Let's begin solving this question. Let's begin with the workings. In fact, here the only adjustment here is the intra-group sales, which is going to result in an unrealized profit. That is the only adjustment that we see here. Now, in the next video, we are going to look at a lot of additional information with this. So we are taking you step by step. So in the next video, we'll solve quite a complete question with a lot of additional information, and I will explain them for you. For now, let us look at what we have here. But let's look at the group structure first, because this is not 100% acquisition. We are told that JB acquired a 60% holding in Ewonia 3 years ago. So you start with your group structure. So your workings, the first one is the group structure. And the group structure means that the parent has 60% holding and the non-controlling interest has 40% holding, making it 100%. So this is the group structure. And in this case, the parent is JB. Okay, so the parent has 60% and there is also a non-controlling interest, making up 40% of the group. And this is for ownership in Ewonia Limited, which is a subsidiary. Now, the next working we have to look at is the group retained earnings. But we cannot look at the group income surplus until we are done with the consolidated statement of profit or loss itself. And so I want us to consolidate what we have first. Let us look at the unrealized profit, calculation of the unrealized profit on the intra-group sales. Now, let's read that question again, or that additional information. We are told that during the year, Ewonia Limited sold some goods to JB Limited for 40,000 Ghana cedi, including 25% markup. Now, pause and listen. Here again, you need your knowledge of markups and margins and discounts, okay? Now, we are told that it is 40,000, including 25% markup. Now, what it means is that the 25% markup was on the goods that was sold by the subsidiary, Ewonia Limited, to the parent, JB Limited. But this 25% is already inclusive in the 40,000. We have added it. You have been given a markup, but you have been given the sales value. So you need to convert it to margin before you'll be able to find your profit. It's very, very important. So the 25% is already in that. It has been added to give you that 40,000. So what it means is that if you want to find the profit element on the sales, it is your 40,000 Ghana cedis multiplying 25 over 125. Because this value is already up to 125%. Because the 25% has already been added. And therefore, that is going to give us 8,000 Ghana cedis. So what it means is that the actual value or cost of the goods was 32,000. And then we calculated 25% of 32,000. And we had 8,000 and we added it. But because it was a markup and we have been giving selling price, we need to convert markup to a margin before we'll be able to find our profit. So this was the original profit. Now let's continue to read. We are told that half of these items were sold in inventory. Half. So whatever it is, half means that 20%, 20,000 has been sold and 20,000 is remaining. Therefore, half of this profit has been realized and half is unrealized. And therefore, unrealized profit is going to be half of 80,000 or 8,000 Ghana cedis. And that is going to give us 4,000. So it is actually 4,000 Ghana cedis that is unrealized profit. I'm sure this shouldn't be too difficult for you. Let me take it step by step for you again. 40,000 is the sales value of the goods that was sold by Ewonia Limited to JB Limited. In this case, Ewonia Limited is a subsidiary. Ewonia sold goods to the sales value of this amount with a profit of 25% markup inclusive. So what it means is that the value, the cost of the goods we didn't know, but we are told that they included a 25% markup, so it's already inclusive. So what it means is that we need to, this value is already up to 125%, so we have to find a profit element this way. If you make it 25 over 100, you are going to get it wrong because that will mean that you have taken this 40,000 as the original cost. But no, the original cost is rather 32,000. If you take 8,000 out of 40,000, it means that the original cost was 32,000 Ghana cedis. And therefore, when you find 25% of 32,000, it's going to give you 8,000. And then it was added to arrive at the 40,000. That is the meaning. So this 40,000 already has that 8,000 inclusive. And this is how we are able to fish out the 8,000. And once you have the profit, bingo, we are told that half remains unsold. And it is the portion of the profit that has not been realized that we need for the purpose of consolidation. And I have told you that in consolidating your statement of profit or loss, you are going to take out any intra-group sales. So this whole 40,000 will be reduced from our sales consolidation, and then it's also be taken out of the cost of sales. However, we are going to add back the unrealized profit to the cost of sales, and that is what we need to start with. So I'm going to prepare the consolidated statement of profit or loss with you. Okay, so let's prepare our consolidated statement of profit or loss for JB Group. So, consolidated statement of profit or loss for the year ended 30th June 2019. So we show our currency sign. So we are consolidating and we begin from the top. We start from revenue. So revenue, just as I taught you, it is the revenue of the parent plus the subsidiary minus any intra-group sales. Remember that I told you. Therefore, the revenue of the parent was 403,400 according to the question, plus the revenue of the subsidiary is 193,000. So plus 193,000 minus the intra-group sales of 40,000. This time we are taking the entire sales value. We are not just taking the unrealized profit. We are taking the whole sales value because it has inflated our revenue unnecessarily. And therefore, that gives us a total of 556,400. So this is how the revenue will show. You know, this is a very simple step. We are yet to go into so many additional information or adjustments. Okay, here the only adjustment is the unrealized profit. That is all. And so we need to just quickly consolidate it. Now, I'm going to also teach you how to calculate the group income surplus with this. Okay, that is the next step we have made from the previous video. Now, cost of sales. Cost of sales will also be that of the parent plus the subsidiary minus any intra-group sales plus unrealized profit. And therefore, the cost of sales of the parent company was 201,400 plus that of the subsidiary was 92,600 minus 40,000 again plus 4,000. Where am I getting this 4,000 from? That is the unrealized profit. So it is the parent cost of sales plus the subsidiary's cost of sales minus the intra-group sales, which became a cost to the parent, plus the unrealized profit. All right. And that is going to give us a total of 258,000. Yeah, 258,000. So that will be in brackets. And therefore, we have our gross profit for the group. Now, the gross profit will be this minus that, which is 298,400. That becomes your gross profit. Now that we have subtracted to get a gross profit, let's go back to the question. We have distribution costs and administrative costs. There are no adjustments affecting that, so let's quickly put them together. Remember that consolidation means adding across. So distribution cost for the parent was 16,000 and for the subsidiary is 14,600. So 16,000 plus 14,600. That is going to give us 30,600. I put that in brackets. And then administrative expenses. Parent is 24,250. Subsidiary is 17,800. So administrative expenses, I add that of parent and subsidiary, 24,250 plus 17,800. And when we combine the two, we have 42,050. Put that in brackets because we are subtracting. And the next thing we can see is dividend from Ewonia. Now, remember that Ewonia is a subsidiary. And so Ewonia is paying this 15,000 Ghana cedi dividend to the parent JB. However, we have said that when consolidating, dividends from subsidiary to parent will not be shown on the consolidated statement of financial position because you cannot receive dividend from yourself. What we are doing, we are preparing accounts for them as a group to be seen as a single entity, and therefore you can't pay yourself a dividend. And by the group or the subsidiary paying dividend to the parent, it is seen as receiving dividend of itself. That is the group. Therefore, we don't show dividend receipt from subsidiary, so that will not come. So straight away we take the expenses out of the gross profit, and that is going to give us the profit before tax. So profit, I think there was no interest in this question, so straight away we have our profit before tax. And the profit before tax is going to be 225,750. And the profit before tax is gross profit minus these two expenses, okay? You punch them manually on your calculator. And then from there, you have your income tax expense. Now, your tax expense is simply the addition of that of the parent and that of the subsidiary. Please take note. And so the tax expense of the parent was 61,750. And that of the subsidiary was 22,000. And therefore, the total income tax expense is 83,750. That also in bracket to give us our profit after tax. And the profit after tax for the year is 142,000. This is why I want you to pay attention. Once you have your profit after tax, this is your profit for the year. That is to be taken to your statement of changes in equity. However, because this is not a 100% acquisition like the previous video, we need to now show which or how much of the profit is attributed to the non-controlling interest, which is the 40% holding people. Those who have 40%, those who have 40% shares in the subsidiary Ewonia. How much of this group's profit is attributable to them? And then the remaining will be attributable to the parent. Now, if you are not very careful, you may just punch 40% of this amount and you think it is the share of non-controlling interest, and therefore the 60% will be for the group. But that is not it. Remember that this 142,000 is not just the profit of the subsidiary. This is the profit of the combined business, the group. So this is the combined profit for the parent and the subsidiary. And the non-controlling interest has 40% share, not in the group, but in the subsidiary, Ewonia Limited only. The non-controlling interest do not have a share in the parent company's profit. They only have a share in the subsidiary's profit. And therefore, we need to work out 40% of only the subsidiary's profit, not 40% of the entire group's profit. Please take note. You need to work out only 40% of the subsidiary's profit. This is the group's profit. You dare not punch 40%. If you do so, you will be sharing the profits of the parent as well to the non-controlling interest, and that will be a disaster because we are looking at non-controlling interest profits, their share of the profit in the subsidiary, not in the entire group. So how are we going to go about it? Let us do that as workings. Okay, so let's look at the working. That will become working 3. So let me just put it here, and let me call it the NCI share of profits in Ewonia Limited, which is the subsidiary. Now, this is very simple. Here, our focus is not on the combined profit. Go back to the individual or the separate financial statement of the subsidiary. Look at their final profit and just give them 40%. That is all. Except there is an unrealized profit that is coming from the side of the subsidiary. So let's go back and look at it. The profit for the year for Ewonia Limited is 46,000 Ghana cedis. That is the final profit. So simple. We just calculate 40% of that 46,000 for the non-controlling interest because that is where they have a share. However, it was the subsidiary Ewonia Limited that made the sales to the parent for the intra-group transaction, and therefore the unrealized profit of 4,000. Okay, the unrealized profit of 4,000 that we estimated is a profit for the subsidiary that was not realized, and therefore it will be borne by both the parent and subsidiary. Now, take note that I have said it before in the consolidated statement of financial position when I was dealing with intra-group adjustment. I said that when a parent sells to a subsidiary and there is unrealized profit, it is fully borne by the group because non-controlling interest has no share of that profit we would have been earned. But if it is the other way around, if it's a subsidiary that is selling to the parent, remember that NCI has a share in the profits of the subsidiary, and therefore any unrealized profit that we are suffering as a group, they have to suffer their share. Therefore, this 4,000 has to be split into 40-60. Okay, for the purpose of calculating their share, because this 4,000 is already inside the 46,000 profit that we are talking about, and therefore they need to also suffer their share, and therefore this is how we go by their share of their profit. There are two approaches you can use actually. You can just find a percentage of the 46,000, okay, and then let me show you all two approaches. You can say NCI share of profits of Ewonia Limited, that will be 40% of 46,000. When you do this, you are going to get 18,400. Then once you are done with this should have been their share. Then you subtract their share of the unrealized profit. So they need to take out their share of the unrealized profit as well. So that will be 40% of 4,000. And 40% of 4,000 is going to be, is it 1,600? Yes. So you subtract that. And once you subtract 1,600 from 18,400, you're going to have 16,800. So this is going to be the share of the profit of Ewonia Limited. That is NCI. Now, this is another way you can go about it. You could have just said, let me show that here. You could have just said that to get your share of NCI, you calculate the full profit. So full profit of NCI, profit of the NCI or the Ewonia Limited, total profit is 46,000. Then you less the total unrealized profit of 4,000. When you do that, you're going to have 42,000. Okay? And then you find 40% of the 42,000. So 40% of 42,000 is going to be 16,800. So either you are going by this way or that way. Whichever way you are going, you have to get the same answer. Okay? So if you go this way, it means you first find a percentage of their share of their profit, and you take out the percentage of their share of the unrealized profit. Or you can just come and take the full profit, take out the full unrealized profit, and you find a percentage of the resultant figure, and you are still going to get 16,800. I'm sure this is very understandable. So once you have understood this, then you come here. After getting the profit, okay, you can do one underline. Then you say NCI share of the profits. Then you come and pick this figure, 16,800. You can even decide not to do any underline. So NCI share is 16,800. So once you take out the NCI share of the profit, the final one becomes profit attributable to the group. So it means that if you take out 16,000, which is attributable to the minority or the non-controlling interest, the final figure that you have is the actual profit that the group is supposed to enjoy, because this portion of the profit is going away to non-controlling interest. And when we take this out, we have 125,200. And then, ladies and gentlemen, this is the profit that is attributable to the group. Okay. I am sure this is very understandable. Okay. So now that we are done with this, there is only one last thing to do. We need to prepare the consolidated retained earnings or the group retained earnings, because we were given a retained earnings for both companies, and therefore we need to prepare the group retained earnings or the consolidated retained earnings to see that of the group as well. Okay. So let us prepare the consolidated retained earnings. For the year ended 30th June 2019. So let me show my currency sign. Now, we all know how to prepare an income surplus account. It's the same thing. Your opening balance, add the profit for the year, you pay out any dividend or any expense, then you have your closing balance. As simple as that. But remember, you are preparing for the group. So if you are talking about the opening balance, you need the opening balance for the group, which is that of the parent and the subsidiary. Now, look at how I'm going to do it. When you come to the opening balance, which is the balance brought forward, you need to bring two balances. You know, in the question we have, looking at the statement of changes in equity extract, for JB Limited, there is a balance at 1st July 2018 of 163,000. That is the opening balance. And there is a 61,000 balance for Ewonia Limited, who is a subsidiary. However, even though both are the opening balances, that of the parent will come as it is. But for the subsidiary, the 61,000 that you see there may not be exactly what is attributable to the group, because that 61,000 will include a pre-acquisition retained earnings. That was there before we bought before the JB Limited acquired the subsidiary. Look at what it says from the introduction. JB Limited acquired a 60% holding in Ewonia Limited 3 years ago, when Ewonia's retained earning balance stood at 16,000 Ghana cedis. So before the parent bought the subsidiary, there was already a pre-acquisition retained earnings of 16,000, which the parent has no share in. So we can't add that to our opening balance. And therefore, ideally, what we need to do is that we need to subtract 16,000 from the 61,000 now to get the true opening balance that reflects the group. So that is the first thing you should know. So let me just write this first. So for balance brought forward for the parent or JB Limited, it's actually 163,000 Ghana cedis. So 163,000. Now, when it comes to the subsidiary or Ewonia, the balance brought forward for Ewonia should be 61,000 minus 16,000. The 61,000 is the opening balance that we have as at now, from starting this very year. 16,000 was there before we bought, so we don't have a share in that pre-acquisition profit. Then that is not all. Even if you subtract this from that, you are going to get, is it 45,000? Yes. You're going to have 45,000 Ghana cedis. Okay, 45,000 Ghana cedis as the opening balance that relates to the group. Remember that the group only owns 60% of the subsidiary. And therefore, even though we have only 45,000, we still need to multiply it by 60% before we can get our true opening balance. Let me get this well for you again. We have all understood from our previous videos on consolidation that we don't include pre-acquisition profit as a benefit for the group. And therefore, if we have a current opening balance of 61,000, then obviously this is inclusive. So we need to take it out. That gives us 45,000 Ghana cedis. Now, these 45,000 Ghana cedis that we have, we also need to understand that 45,000 is not for the parent company only, because we are talking about the subsidiary here. So it is for both the parent and the non-controlling interest, because that is 100% of their opening balance, and the 100% is split into 60-40. Therefore, to get that for the group to consolidate, we need only 60% of that opening balance. And therefore, you take out your pre-acquisition profit first, and then you find 60% of the remaining. And that is going to give us 27,000. So it means that to get our opening balance only, we take that of the parent and the share of the group in the subsidiary. So 163,000 plus 27,000 is going to give us 190,000 Ghana cedis. So 190,000 becomes the balance brought forward for the group. Then we can add our net profit for the year as a group before we pay out dividends. And the net profit for the year has been established as 125,200. So if you had your calculation of NCI profit wrong, it means you are going to get the group profit also wrong. So our net profit for the year, we pick it from here, 125,200. So we add that, and that is going to give us 315,200. And then we can see less dividends. So we pay out dividend because if you look at the question, there was a dividend payment. Now, the parent is paying dividend of 40,000 Ghana cedis. Subsidiary is paying 25,000. But please, we have said in our previous video that when it comes to dividend payment, only that of the parent will show. Subsidiary's dividend will not show because only the parent is paying dividend. The subsidiary, in this case, is consumed and part of the parent. So the parent is only paying dividend. Any other dividend of the subsidiary will not show in the group retained earnings estimation. And therefore, that will be only 40,000 that we are bringing. So 40,000 Ghana cedis will come as a subtraction. And once we take that out, that is all. There were no goodwill impairments because we were told in this question to ignore goodwill. Going forward, we will look at a lot of goodwill and impairments and other things that will affect the retained earnings. But for now, it's just the dividends that we have to understand that is there. And please take note of how we got the opening balance for the subsidiary. And therefore, this becomes our closing balance or balance carried down, which will be 275,200. And so, ladies and gentlemen, this is how we go by the question. Now, the question looked very simple and small, but look at what we've done, the magnitude of work that we have done. You need to understand the basic principles, which for here, there were no much tricks here. The only thing you needed to understand was treated in the previous video here. So there is no much trick in getting your profit. The only thing that was added in this video was how to estimate the NCI share of the profit and also how to prepare the consolidated retained earnings. In our next video, we'll take a step further, talk about a lot of how to treat a lot of the adjustments, and then we'll take a full question that involves a lot of adjustments, and we'll be able to solve that and then understand. When we are done with that, then we will look at combining, preparing a statement of profit or loss together with the financial position. We'll look at that and solve a question as well. Then we can move to our investment and associates before we start looking at the mixed group. We have a lot to go still with the consolidation or the group accounts. And I indulge your audience that you continue to follow me and let us learn together. If this is your first time, I want you to subscribe to this channel, share this video, let others also have a benefit. And until we meet again for the part 3 of this lesson, is bye for now. Thank you.